Hello and welcome back to another episode of Majlis and Markets with your host, Hassan Javraj. In this podcast, we aim to bring you thought-provoking conversations with influential leaders in Islamic and global markets. Before we begin today's episode, wherever you're listening to this podcast, please remember to like, share and subscribe. It really does help us. In today's episode, we're talking about venture capital. In recent decades, the global venture capital industry has experienced a significant surge, propelling groundbreaking startups like Uber and Airbnb into mainstream recognition. Despite the promising emergence of venture capital hubs in OIC countries like Dubai, Pakistan, and Malaysia, challenges persist, including regulatory hurdles and restricted access to funding. Today we're joined by Hussein Kanji, partner at Hoxton Ventures, a leading VC firm in London. With his background in Microsoft and Silicon Valley startups, Hussein shares his insights into the global VC landscape, his startup selection criteria, and his perspectives on Islamic orientated startups. Hussein Kanji, welcome to Majlis and Markets. Good to have you here.
Good to be here. Thanks for having me.
Hussein, you've got a really interesting background. I've done a bit of research for this conversation, and you've got a really, really interesting background. Could you maybe give us a little bit about your early life before we get into the more venture capital life and where you are today?
Yeah, I don't think of it as that unusual. I guess the unusual part is I live in the UK versus in the US. But as you can tell from the accent, I'm American, born and raised in New York City. Unlike most New Yorkers who tend to stay back in the city, especially after college, I went to the West Coast and then stayed on the West Coast. And that was not necessarily by design. It wasn't some master plan. It was just I obviously loved the sunshine, but I also fell in love with the tech industry. I ended up doing a bunch of stuff in the tech industry, sometimes founding companies, sometimes working for companies, and kind of got sucked into that whole ecosystem. And 20 years ago, much older, there wasn't really a New York ecosystem in tech. There was a finance community, but not as that community. So I stayed on the West Coast. I then ended up moving to Seattle for a few years to join Microsoft. I wanted to work for a bigger company for a while and kind of see how a big behemoth, which is what Microsoft is, runs itself, to kind of have that perspective. And I did that. I did not like Seattle all that much. It's been quite. I love the mountains and the nature, and I didn't like the weather. And Seattle is not a first world city. It's not on the same level as a New York or a London. And the Bay Area has a lot to offer, but Seattle is pretty provincial and small. So I left and I came out here to London. I thought usually you need an excuse to go to different places. Sometimes the excuse is a job. In my case, the excuse was business school. And I thought, you really want a more international perspective. It's useful to go and do business school somewhere else. And, that forces you to live in a city like London. Again, I didn't really plan on staying in London, but that's what I said 18 years ago. I ended up joining a venture fund in London, which had the thesis of investing in these entrepreneurs that were kind of coming out of the ecosystem. They were probably a few years too early to that thesis. The thesis has definitely played out. And then I left and I formed my own fund, which is Hoxton. And so, I've ended up kind of settling in the UK. My wife will remind me that I have a promise to her that at some point when our only son, not even our eldest son, our only son is 20 months old. But by the time he's at American high school age and maybe even American middle school age, which is kind of secondary school, like probably, somewhere between 12 to 14, we will end up going back to the US so you can have an American educational experience as opposed to an English experience. I'm not so sure how he feels about that. He doesn't have a say right now, but he might have a very strong say about this 10 years from now. So I don't know what we're going to end up doing, but that's kind of the handshake that I have with my wife. So I'm probably here for another decade and then probably off to the US. And to be fair, I think I'll be out of market at that point. I don't think I'll have any tangible skills by that time. That's a long ways off, and I think I'll have atrophied all my muscle memory on building tech companies by then.
Right, very good. I read somewhere that you actually wanted to be a journalist. Is that true?
Yeah. So when I went to Stanford and my whole freshman year, I was writing for the paper, and we had this weird situation that had happened where at Stanford, like most American universities, is a 4-year program. And so the terms are freshmen as a first year, sophomores as a second year, junior, senior and senior being the last 2 years. and all of the sophomores had quit the paper. So usually freshmen, like first years, don't get any, they don't get to do anything, right? Like they're the June, like maybe they write one article every once in a while, they go get coffee for someone who's writing an article, and that's kind of that pecking order in this thing. But because all the sophomores had quit, there were four of us who had a lot of airtime. Like we each read, like if you pull down the papers, and Stanford keeps all these papers and kind of these bound manuscripts in the office of the newspaper. And every day I had an article in the papers, and then I became an editor the following year. And I would have probably stayed on that track. And I would have tried to intern at the New York Times or something like that. I would have stayed on that track if I hadn't gotten sucked into the tech industry. And the tech industry made it really hard to juggle all of this stuff. I had to leave the paper kind of midway through to be able to do that. But I enjoy writing. Like that's what I always thought I wanted to do when I grow up.
Yeah, no, I think you're very infamous for your Twitter feed and some of the stuff you post on Twitter. It's very, very famous in the venture capital world. And yeah, we'll
Yeah,
get.
my Twitter feed is probably a little too direct. And then it's mostly like sharing articles. But I think, the challenge is once in a while the articles have some commentary to them and people find it,
Yeah, I
people
think
find
it's
it
something like
very direct.
good or tech and eat cake or something, right? Or something like
Yeah.
this. Um, but I also understand you worked at Microsoft for a while. What happened there?
I did, yeah, yeah. So like I ended up interviewing with a venture fund a long time ago, like when I was still in the Bay Area, and I sat down with one of the partners there, and he said, "Look, you're a bright guy. You should not join a venture fund unless you're joining as a partner, or you have a very clear path towards a partnership." And the challenge with these, you have a lot of interesting young company experience. Most of my young company experience is like how to screw up. Like it wasn't like necessarily how to build a lot of value. We had one or two things that actually got a decent outcome, but they were decent by venture standards. These are not like the $10 billion companies, like, or we're going to grow into that. It's like you've learned a lot of that stuff. It's useful because you can, get people to avoid making the same mistakes. But you also need to see what like good looks like. And good is like either you join something that's scaling up, but the easiest, safest way to learn what good looks like is you go for like a bigger, like well-known, execution machine. And back then, there weren't that many software companies that would gotten to that. Like this is in the mid 2000s, right? Google was still really small, so that wasn't on my list. Uh, and so, it was Adobe or Oracle or Microsoft, and like all of those have very different cultures. Adobe's turned itself around and become much more cloud oriented. Oracle was much more of a sales shop, and Microsoft was much more of a program manager, product manager culture, where someone who's kind of in both camps, technical and business, kind of can do well. And I went to Microsoft. I thought I'd stay like a year. I ended up staying like nearly close to 4 years. I did well at the company. They put me in a leadership program. Like it was good experience, and I just didn't like Seattle. Like, and to be fair, I actually like Seattle. I didn't like Redmond. Like where Microsoft is on the outskirts of Seattle, and the nature of traffic in Washington State is it takes about an hour to an hour and 20 minutes to cross from Seattle, like downtown, into Redmond. And so it's like a two-lane highway. They drive at like 45 to 50 miles an hour. It's like it's infuriating. It's like there's no public transport. It's like the world. It's like an awful commute. And so you end up living close to campus, and then it's incredibly boring. So like after 4 years of that, like you get a lot of snowboarding done in the winter, but like there's not much to do in Seattle. Yeah, and I did not like the Muslim community in Seattle either. It was very backwards. So that was the other. Like the Bay Area has a very vibrant Muslim community, and New York City has a very vibrant Muslim community. London kind of sort of does too. More like Seattle, unfortunately, compared to the U.S. or compared to like the Bay Area. But in Seattle, it was like super super backwards. It was basically a bunch of day abundance who kind of ran the place, and it was like incredibly boring to go to events.
Right. And this was in the early noughties, so like the early 2000s. So we're talking probably more than 20 years ago, right?
Yeah, I feel like if you end up with like a bunch of engineers or maybe scientists, but they're mostly engineers with like some money, they will have a very like backwards version of Islam. Like, it will be very rules oriented. It will be very like very cut and dry. Like it's not particularly interesting. Like, Stanford at least had an academic community around it. There were a bunch of people who studied more than just engineering, or much more interesting. But like, you end up with like a fire and brimstone uncle in Seattle all the time, even the football. Like, it's like I don't get to listen to this.
Yeah. And you mentioned your breakthrough in venture capital. I mean, before we get onto Hoxton and what you're doing today, um, where were you? How did you break into the VC world? like your former
That
rate?
same person who told me to go work for a bigger tech company. When I moved to London, I sent my goodbye emails to Microsoft, and he was one of the people I sent it to. And he kind of, unbeknownst to me, sent it to someone at Axel and said, this guy's really bright. He's moving to London. Maybe you guys want to talk to him. Like I came in for a coffee meeting like a week or two later, and then the coffee meeting was like a long 2 hour, 3 hour meeting, and then it was like multiple meetings, and then I worked on a project. I worked on a second project, I worked on a third project, and next thing you knew, like they designed kind of a job for me while I was still in school.
Very good. Yeah, and then I think was it in 2013 you set up Hoxton Ventures?
Yeah, so I left Axel in like 2009, and then I fundraised for a while to set up Oxford. We launched it formally in November 26th, I think, or 24th, 2013. So we're a little bit over 10 years old now.
Right. And I think what's interesting from my readings is that the way you've structured your venture capital fund is that it's a bit different to others. Like, could you maybe talk a little bit about that?
Yeah, I mean, it's not that different. It's very US centric in this sense. I mean, we're looking for new category creation, so we're not interested in like no, there are a lot of Europeans who want to build like copycats of what's going on in the US or kind of the local version. And we still see this like to this day, like with AI nationalism, people want to build the AI engine for the country or for the region. Like, our view is these markets are global. Like you want to build global companies, and if you want to build global companies, you got to win the US market as early as possible. So that's what we focus on. And then as a firm, we're organized to not have any juniors in the firm. So we're all senior. We split the carry and the profits of the firm equally. So I don't take out anything more than anybody else. Like our view is it's a team sport. It's really hard to get all these things right, and you need everyone around the table to be, to feel like that it's an ownership culture, that to feel like it's their firm. But that also means like you have to put in the hard yards of like, the counterbalance to that is like you have to behave like an owner, which means like you're kind of all in. We're pretty all in terms of people. So it's a good culture, but it is unusual, I think, by most venture firm standards in Europe, which have a much more of a hierarchy, and then they have younger staff kind of screening things or doing some of the grunt work that the senior people don't want to be doing.
Yeah, it seems a bit weird. Like, the venture capital industry in the UK is obviously, it's there, but I don't think it's as sophisticated or as developed or as deep as, say, the US, Silicon Valley, this kind of thing. Would you see the difference over, like, say, the last 10 years or like even like when you started at the other place? Would you say that it's different in terms of culture or in terms of risk appetite or approach
It is, but it's rapidly catching up. So I think it is looking more like a U.S. community than it used to in the past. There are more ex-operators and more founders, more people who come out of the industry versus traditionally, which is more people who came out of banking or maybe consulting if they were younger. It looks more like a U.S. model. There are not as many equal partnerships, but there are not as many equal partnerships in the Bay Area either. So I think that's a more limited feature of venture firms. But it feels more like it does in the U.S. here. And there was a time where I think a lot of people in finance think because venture is small amounts of money compared to what normally happens in finance, like you're not going to buy like a mezzanine debt with like $100 million in venture, like that's the size of a fund. So they just thought of it as kind of baby finance. Like, if you're writing 500,000 or 2 million or $5 million ticket, it's like, it's such chump change by finance standards that you really didn't have to be particularly bright or special. Like if you're writing a $500 million financing into something, you have to be really good. If you're writing a $2 million financing into something, like pretty much anyone can do it. And I think what people didn't understand is like venture is not baby private equity or baby finance. It's its own little thing that works in its own like unique way. And you have to get really good at doing it because you're not shooting for like 2x, 3x, 5x returns on these things. You're shooting for like 100x, 200, 500x returns. And that's a very different skill set.
Yeah, no, I think when I first watched Dragon's Den way back in like 2005 or watching Shark Tank, it just kind of reminded me like that. You sit in a room of investors and someone pitching to them and like they would scrutinize the idea and asking like why, they'd ask for so much money for so little return in equity.
And
Um,
Dragon's Den feels horrible to me because like they're just mean. Like, in Shark Tank, they can also be mean and they can point out like flaws and they'll ask tough questions, but they write the check. Like a good chunk of the time, like someone gets funded, at least in an episode. In Dragon's Den, they just beat up on these poor people and then never write the check. And when they write a check, they're like, I will give you 10,000 pounds. Like, it's like, what am I going to do with 10,000 pounds to go build anything of significance? Like, it just feels like it feels like it highlights the cultural gap between the two places. Is like one show is all about like trying to create some greatness and like create some fanfare around that, and the other one is about pulling people down. Like, and this like feels culturally much like Dragon's Den feels culturally much more British.
Yeah, and I think the idea comes from like Japan, if I'm not mistaken. Like I think Japan, the concept of Dragon's Den and Shark Tank. But like I think I read a stat somewhere that 86% of even pitches which were accepted or like invested in on the screen on the TV, they don't get invested in after the due diligence stage. Before we get into like the investments, what would you say your typical day looks like as a VC? Like what do you do on like a day to day? Like I think people would be interested to know like what do you do as a VC day to day?
Yeah, my entire day is basically meetings, and I have a big enough portfolio now where having the funds grown up for a while, and so I sit on a bunch of boards, and so a lot of my week is scheduled like weeks or months in advance because I just have standing meetings with some of my companies, some of my CEOs, formal board meetings, and then the rest of the stuff where there's a little bit of padding, I have other meetings. So I might be meeting investors, I might be meeting other entrepreneurs, I might be meeting other investors. It basically I wake up at like 7:30. I might have a breakfast at 8, and then it's back to back to back meetings. And maybe when I'm walking home, I have a phone call on the way home until I get to home, which is about 8:30 usually.
And could you maybe talk a little bit about some of the investments you've made at Hoxton? I know probably the most famous one is Deliveroo, and some other ones, but could you maybe talk about some of the investments you've made?
Yeah, so we have a very eclectic portfolio, and Deliveroo was in our first fund that did well. We also did Babylon, which did well, and then went public in its back, and then didn't do so well. We also did we did Dark Trace, which is a cybersecurity business, which is probably our best investment. Um, in the second and third fund, we did an AI drug discovery company called Peptone that is able to figure out intrinsic disorder and then run a computational model to go build drugs that kind of predict the disorder and then fix the disorder. It's like super interesting. It's very science oriented. We have a next generation COVID vaccine company, and they're doing much more than COVID vaccines. But one of the things that they built is a vaccine for COVID that is mutation proof. I think we all
Right.
know what mutations look like for COVID because we've lived through it. So like it'll be one dose and then kind of done. They're doing really well. They just announced a fundraise a couple of weeks ago. We have a piano learning company that uses computer vision to figure out where your hands are and then teaches you how to play the piano and can do that kind of asynchronously with or without a tutor. So the software can do it, the tutor can do it. That's like super interesting. It's called Boomi. And like we have a very eclectic portfolio. We're trying to find these companies that like if everything goes the right way, they become iconic, they become big, kind of the same way Deliveroo became big or Dark Trace became big.
And when you were investing in Deliveroo, what made it attractive for you to invest in? Like, could you see that this was going to take off? I'm talking like even before the IPO, but could you see like it becoming more mainstream?
So we turned it down twice. So when Will had the idea for the business, he sat down with me. He knew that I, through some friends, that I owned a restaurant, like a bakery business in London, and so he knew I knew something about food, and so he kind of sat down with me to get some advice. And I was like, I tried to talk about doing Deliveroo because I didn't think it was a great idea, and I thought he was a former hedge fund manager. He could make a lot of money just going back into finance in the city. And then he decided to do it. And he came back to us again and asked if we'd write the check. And we were just setting up our fund at that point. So we were pretty distracted, but also we said no, because, it wasn't clear if there was going to be anything there. And then he launched it and then he was growing something like 5 or 7% week on week. So, he was doing a lot of the deliveries himself. Like he was tagging the doors, like, he was doing a lot of the work, but like we saw, hey, there's actually a lot more. So this market is much bigger than we thought. Like people just don't grow 5% week on week unless they've like hit a nerve in terms of what they're building. And our biggest problem was like we didn't think the market cared enough to use it. Like we thought it was like a problem that a few people had, mostly like finance people who had like high incomes and they wanted food, but we didn't think it was a mainstream type of thing. And it was very clear, like at 5% week on week, this could be much more mainstream. We still didn't know how big it could become, but we were willing to kind of take the check, and we ended up of doing it.
Yeah, no, it seems like 2014, 2015, this is when like all the major startups like say Deliveroo, Uber, Airbnb, and like, all these startups seem to have come out of nowhere, or seem to be more in the mainstream. Would you say like it really took off in the last 10 years, with a lot of these
Yeah.
big investments?
Yeah, I would say a lot of the culture changed like in the late 2000s, early 2010s, and people were much more ambitious. And then, the global distribution platforms like the App Store or the Facebook like distribution strategy or even Google were all there in place for people to take advantage of so they could kind of scale an audience. Like you could build a Rovio or Angry Birds and kind of get to a billion users around the world. You couldn't do that before. And then because of the financial crisis, a whole bunch of people were at Cambridge, Oxford, Imperial, like all the good schools in the UK, their jobs all dried up. Like what they would normally do is interview and go to work for like a bank or a consultancy. And because of the financial crisis, they couldn't do that. So like Tom Blomfield, ended up building a company and went to Y Combinator, and that was Go Cardless. And then he left and then formed another company, which was Monzo. He was one of the early people in that era to go off and do something like that. And people looked at him as kind of insane. Like you did not graduate from Cambridge or Oxford and go work. Like forget about building a tech company. You didn't even go work for a tech company. Like the tried and tested path was OCNC or LEK or Goldman Sachs, Morgan Stanley. And so you saw a few of these people kind of go a little bit more rogue because the jobs weren't there and they were interested. Y Combinator had set up around the same time. So people then went to YC. And the whole thing just became like much more virtuous. Like, it just became much more, it kind of builds upon itself in a good way. And so the raw ingredients were there in the late 2000s. It started really happening in kind of the 2010s. And I would say by like 2015, 2016, it was very clear that there was an economy here that was going to go the right direction.
Do you think also that the cost of funding, like capital, was quite cheap back in those days, like compared to today? Obviously, rates are where they are, interest rates are where they are, so capital's no longer cheap. So a lot of these people were just throwing money around just to
So we
see.
looked at we looked at this in our first funds. Like there was an era where like the TransferWises of the world were the generation before our fund set up. And if you look at what they raised and what their valuations were, they were very modest. And then Deliveroo was the first of this new generation that Deliveroo like raised a $5 million, so £3 million back then, seed round. A year ago, a year prior to Deliveroo, the seed rounds were like 1 million at max, maybe 500,000, right? So the world changed like around the time that Deliveroo formed. And then the world massively changed post Deliveroo, where like you got seed rounds in the 5 to 7 to 20, and then you saw Stability raise 100. Like, these things would have never happened. And a lot of that stuff was fueled by like cheap interest and especially during like zero interest rates. And then just a lot of enthusiasm for AI, which is where it is today.
Yeah. And have there been any investments where it wasn't so successful? Maybe, I don't know if you can talk about some that didn't go so well, or
Yeah, every venture fund has a fund. So we did one called Algomi that was like a next generation bond trading marketplace. And so with corporate bonds, they are unlike government bonds, they're not really traded on exchanges. So they're all held by banks. And so the banks know who the clients are that hold they're not held by banks, they're held by the clients of the banks. And so the bank is acting as a broker in terms of like I have Vodafone corporate bond from like 3 years ago, and then someone wants to buy it. They kind of know how to make the market for it. In an ideal world, all of that should just be a matching engine. Like you should have the inventory, it could be anonymized up the client side, and then you know who's like looking for it, and then should just like basically go match. The problem is a lot of the banks are run by the salespeople who get commissions on these kinds of things. And then there used to be a time in the global financial crisis, pre-global financial crisis, where the banks could take speculative risk. They could pick it off the client, they could hold it on their balance sheet, and then go find a buyer for it. So they were actually adding some value to the transaction. Post global financial crisis, they had to act as a broker. Like this should be software. And so this company went off and said, like, connect to us, give us all your data, and we'll do the matching. Obviously, if you're doing a robotic matching, you're replacing the jobs of the salespeople. So they had to spin it as this will be more value additive, it will help you find the higher value clients and let you do more transactions. And they did pretty well, but it was really hard for them to crack the US data set. And so they eventually ran out of cash and ended up getting acquired by Euroclear.
right, right. And Hussein, when you're looking at companies, what are the things that you look at before you want to make an investment? What sort of metrics or criteria do you look at Or maybe like what's the mandate of your fund when you're looking at these kind of new investments?
Is it a brand new market? And do we think that this company here could actually grow to be the global winner of the market? And why do we think that's the case? And then will the founding team hire better than themselves and be able to kind of build a world-class organization around themselves? That's kind of it.
What do you look for specifically in a founder, let's say, for example?
So it's less the founder and more who they are able to recruit around themselves. A lot of the folks that we write checks to, like they've never built a business before. This is the first time they're ever doing a company. They don't come from like deep experience in any one field. That's, they weren't the CEO of NVIDIA before they're forming their new company. Like that's just not the backgrounds of these people. They might be young, might be early in their career. They might also just be, they might have been junior in those organizations. They're working on something. And then the question is, who do they hire around themselves? And if you're doing something interesting and you hire, you're doing something in email and you hire the head of Gmail, that's a pretty good signal that whatever you're working on has captured the imagination of someone very senior in their industry. And the fact that you can actually pull them into your organization is also a very good sign, because you can't build these organizations if you don't hire. Like, these things are an idea, and then they're people and their capital. We can solve for capital. The idea comes, from day one. And then the question is like, who do you end up building around the organization to kind of get to world class?
Right. Right. And then when you're happy with like the team and like the founders and the idea, well, I guess the idea, the proof of concept and all of these things, and then you're happy with some of the KPI and some of the criteria that they're doing. How does it work on the investing side? What kind of financing structure do you do? Is it like Dragon's Den where you make an offer and then you get equity, or is it done through debt or?
It's mostly equity. So almost everyone in the venture industry uses the same thing, which is preferred equity. So, we become minority investors, and then we use this concept of preferred equity, which is like a senior equity that gives us like governance rights or protection. So we're basically, even though we're a minority, you can't do something like spend $250,000 on something without getting our permission. So like you have these defensive protections, and that's by virtue of you holding this preferred stock. You put in these rights into the preferred stock. So, you don't own 80% of the business, you only own 20% of the business, but the 20% has a little bit of teeth to it for defensive things. Like, it can stop people, it can stop someone from doing a sale without the consent of the person. So like even if you're not a majority owner, you basically have to be looped in. And we do this largely because we don't want to be majority owners. We're kind of along for the ride, but you want protections to make sure you're protected along the journey.
And you're investing at seed or pre-seed or Series A? What level are you investing at? What stage are you investing at?
We do mostly seed and pre-seed. So we're like a third of the time we're sheet of paper, and then 2/3 of the time we're the first institutional check.
And then when like does it really when does it, like the money starts getting like serious in terms of returns? When does that happen? Does that happen at IPO or does that happen at exit?
Usually the companies to get big need like 7 to 8 years to kind of get there. So and when they get big, they're usually public offerings, and they may get acquired for a lot of money as well. That might happen a little bit earlier, but generally speaking, they're independent and they kind of go the distance.
So it's actually quite a lot of risk you're taking on. Like some of these ideas can not work at all, or it's very
Yeah,
very.
Yeah, I would say generally speaking, most venture firms, like we are, we're writing we're writing the checks, and we're assuming that most of our businesses are going to fail and never get there. So,
Right.
that hasn't been the case in our first fund. Like we took 3 companies public out of 17, and we wrote the first check into all of them. So we had a very high hit rate, and we probably have like a 4th, 5th, 6th, 7th company that are going to generate some real return for our investors. But that's very unusual to have such a consistency. You're generally saying one company in your portfolio is going to make it and will generate most of the wealth, if not all of the wealth in the portfolio.
Right. And like, who are the investors that give you the money? Are they like family offices or sovereign wealth funds? What kind of LPs are giving you money?
Yeah, so they're mostly, for us, it's mostly institutional investors, so fund of funds, folks who manage capital on behalf of other larger organizations who are deploying into a venture capital strategy on behalf of this organization. So these are like, they're called fund of funds. And then a lot of the venture industry is fueled by the university endowments or the charitable endowments, which have very long time horizons and are not necessarily looking for yield. They're looking to grow the capital base in the endowments. They don't tend to exist as much in the UK. These endowments are more of an American phenomenon. And then there is some sovereign money in the venture industry, but it doesn't tend to get allocated to folks like us. It wants to write checks into very large organizations like SoftBank Vision So we don't end up spending a lot of time with the sovereigns.
Right. So like Saudi sovereign wealth fund, these kind of guys, you don't interact with them too much, or
No, we're too much of a rounding error for them. Like their ticket size is kind of the size of our fund. Like, they wouldn't get excited about investing in someone like us.
right. So it's like very like sophisticated investors or investors who have a very high risk appetite for these kind of things, high risk, high reward, right?
Yeah, I mean, I don't know if it's people, they're sophisticated and then they're looking for like, these, like they look at venture as like a call option that like generates alpha for them. Like it generates extra stuff that they can't get in any other place. They could put the money in the public market, they could buy bonds, like they could do all kinds of things. And they look at our industry as like the thing that will give them 10x returns on their capital. Because if a fund does really well, it can distribute that kind of capital back to its investors.
And with when you invest in a startup, are you quite prescriptive to the founders or to the team? Do you say like this is what you have to do, or do you let them get on with it and then they'll come to you when they need help, or if they need more cash? How does that work?
We are engaged, but not prescriptive. So the challenge is no one in this industry usually knows what they're doing. And so, including ourselves and including the founders, right? If you're in a brand new market, you don't know what the market's really going to shape up to be. Like it's very hard, even today, to say exactly what the long-term implications of generative AI are going to be on, like, say, education. Like even someone who's doing a Gen AI company in education is kind of learning by doing because we don't know exactly what's going to get disrupted, what's going to get replaced by technology, what's going to run interference with the government. Like the government's going to put regulations in place. But we don't know. No, none of us know. So we kind of let the startups navigate that stuff. But we're the sounding board for them. So every single time there's a hiccup, we're usually the first point of call, like, to talk through it. And then we have a view and, we're like, we don't have a prescriptive view, we just have a view and then it's something for them to reflect upon.
Right. Very good. Hussein, what are your thoughts on? I know this may be a little bit, some people have different opinions, but what are your thoughts on Sharia compliance or Islamic startups or Muslim-led startups, particularly in the UK and then maybe globally? Do you have like a view on the ecosystem or the scene at the moment?
Yeah, I can't say I really get it. I mean, I feel like there are people who are looking for products that are Sharia compliant, like finance would be a good example of it, but it is a niche product. Like it is not every single person within the Muslim community. I think a lot of people will say that they are looking for those products and they will elect to go use a traditional bank or a traditional like money manager or a traditional like stock management firm. So what people project and what people actually do are two different things. So I find these markets are just niche. Same goes for like, there was like a booking engine for like travel for families. Like it just feels like a niche product. Like you can go look at Expedia and go qualify the stuff out yourself, and they have a lot more inventory than any kind of booking engine for this. But like there are people who definitely look through these lenses, but I don't think it's a lot of people. So I just wonder if any of these things has like serious legs. You know, it would be no different than if someone asked me like what would the market for like a kosher type product be or like a particular demographic and a particular population where some people really care and a lot of the population doesn't care. I think they're just niche and they're not that like venture is all about like finding things that can become much bigger and explosive. So I think you want to stay away from niches.
When you say this, do you mean specifically for the UK, or are you talking just globally or just generally?
Globally. Like, I just don't see any of these products like getting a ton of traction.
So, like for example, in Malaysia, if there's like a few startups which have a Muslim orientation to them or an Islamic orientation,
There is a market for it, but it's not like 100% of the Malaysian population is going to end up using these things. And, that's unfair because there's a lot of other nationalities or ethnicities or religions in Malaysia other than Muslims. So I don't even think 100% of like ethnic Malays or like Muslims in Malaysia will end up using that product. Like, you're taking a market and chopping up into a subset of a subset of a subset. Like it doesn't feel interesting to me.
what would you say then to like the likes of Wahid Invest or like robo advisors who specifically, are fulfilling a mandate of, Muslims who want to invest or people who want to invest in a Sharia compliant manner?
Yes, I think there is a market for it. I don't think the market is zero. I just think the market is small. So I think the challenge with small markets is you have to become profitable.
Right, right. So what advice would you give to young entrepreneurs, who have like these idealistic dreams, who want to start up these kind of companies with the Muslim angle to them? What would you say to them in order to, get investment from not from the likes of you, or just but like investment generally?
Why? Why not like broaden your horizons and build something for the mainstream?
But like, you don't think that they say, "Oh, we see a gap here for in the market." So, for example, if there's like a modest fashion, let's say, for example, or something specific to Muslims, you don't think that you would say to them, "Oh, just carry on doing this business," or would you say, it has to cater for everybody?
Generally speaking, if you're going to solve a problem, why solve a small problem versus a big problem? Like, why build like a small niche thing when you can build something much more mainstream? And there are plenty of things like you go build another Starbucks and like make it like a much more mainstream type thing, and make sure everything that's in there is like halal or good. Like, solve for the big market versus a small market. Like, why would you want to like artificially like narrow yourself into a very niche like industry?
Yeah, I mean there are some startups I've come across, and I was kind of the same mindset. I was like, why are you doing this? You should be like, if you say it's really good, it should be for everybody, not just for, you know, 25% of humanity. It should be for 100% of humanity.
And I
Uh,
think the nature of like the tech industry is like I think you can build a product for the mainstream and you can make it a quality product that kind of fulfills your like ethical obligations and still make it a mainstream product.
yeah, I agree. It has to fulfill for
You're not
everybody.
you're not going to build like the Muslim OnlyFans, but you're not going to build a halal OnlyFans either, right? So like yeah, there are obviously a bunch of things that you're never going to do, but like you can go build a social networking site for everybody and then just run it ethically.
Yeah, no, I hear you.
I
One of
think
the
that would be a net benefit for humanity versus a net detraction for humanity. Like I would much rather see an ethical Facebook than the current Facebook.
Yeah, and within your fund, I think you've mentioned in a few other interviews that you don't invest in certain sectors. Is that true? Or
Generally speaking, venture people don't do sin businesses. So we wouldn't do like alcohol, we wouldn't do pornography, we wouldn't do gambling. And that's largely because so much of our capital base, not ours at Hoxton, but like the industry as a whole, relies on charitable endowments giving us cash. And so charitable endowments don't want you to go into any of those kinds of sin businesses. So generally speaking, the venture community shies away from these kinds of things.
yeah, I'm just thinking because there was a the Church of England, I think it was, did investment or had holdings in Wonga. I mean, interest bearing bond, interest bearing interest, or interest
Yeah.
bearing exploiting people, these kind of things.
Yeah,
Uh,
yeah. The Church of England ended up allocating capital to a couple of venture firms who then invested in it. And then the Church of England, like one of the bishops of the Church of England, was also the same person who took down Wonka,
mm,
and made a big stink about it. But yeah, I mean, it was kind of absurd that that stuff like flew past the venture funds. And I think the justification at the time was like they're not usurious interest rates. Like I said, I think it's absurd, but they're providing a service to people who don't have access to finance. And so they're able to charge a premium over the market to deliver the service. I don't think any of this stuff flies. Like if you're charging 3,200 something percent to someone, like I'm sorry, like you can't think of a more blatant like example of usury in the market. If you're charging like 15% as opposed to 12%, like and you're charging a 3% service fee, fine, maybe the argument might hold water, but it doesn't hold water when you're charging like a ridiculous APR. And they got called out, right? The business kind of collapsed.
yeah, no, absolutely. Hussein, within the OIC, these Muslim majority countries, um, where do you see the most interesting activity? Like which countries or which regions do you think have the most interesting potential for startups?
Good question. Um, I mean, India has a big Muslim population, but I think the challenge in India is it's politically pretty sensitive to do anything. Saudi has a big spending population, but I don't see a lot of value creation there. But there's a big push towards like nationalization in Saudi to kind of build local stuff. Egypt has a big population, but it's kind of a bit of a mess of a country. Like it kind of shoots itself in the foot over and over again. And then Malaysia is interesting, but it's small, right? And it's probably well run as far as the country goes, but it's small in the grand scheme of things. So like I don't think of any of these countries as particularly interesting investment areas.
Do you think it's more a case by case? So, say, for example, if you see a startup in, say, Pakistan, for example, you'd look at that and be like, this is interesting.
100%. Like, yeah, if you're going to start in one of these countries, like, why not build a product that's like a global service? Like, you can build these things from anywhere. I would say the same thing to someone who's in Estonia or in like Latvia. is like, why focus on your own market or other neighboring countries around you? Just build a product or service for everybody. And if you scale, then the question is like, you'll have to go win America, but that, you have to go get finance, et cetera, to be able to do that. And then eventually over time, like these things become very mainstream. And if you think like, if you just open up your phone, right, and look at the applications that you generally consume, they're all going to be global applications. They're not like custom applications for the country, including in many of these countries like Saudi.
Yeah. I think like within the OIC, or if you break it down, there is a lot of human capital and probably some good ideas there, but a lot of countries, they're in political turmoil or economic turmoil. And like a few places like Dubai and, Saudi's trying to become like a VC hub kind of thing. Do you think like these kind of things are important? Like, where do you see as a hub within the Muslim world? Do you see like Dubai or Kuala Lumpur or?
I don't think there is one. I think these things, the nature of these things, it's a very democratic market. Good ideas kind of bubble up to the top and then they go global. And the challenge is like which countries are equipped to build global stuff versus like local stuff. And there are a bunch of people trying local plays of things, but I think it's again narrow and niche, right? Like, the Facebook of Saudi is Facebook. The Snapchat of Saudi is Snap. The Instagram of Saudi is Insta. Like there's no Saudi version of these products. Like, so like global products tend to win globally. So if you're starting in any one of these places, just focus on winning the entire market globally. If TikTok can figure out, like out of China, can figure out how to mass market a product to American teenage girls, which are a really finicky population. Like dealing with teenage girls is not the easiest thing to do. If they can go figure out how to crack that market from China, you can surely figure out how to crack the market from any one of these countries globally.
And what about Africa? Do you think it's the same thing? Like, do you see any activity in Africa that's interesting to you?
It's big in population, but its GDP is low. So like I think you focus on all of these countries after you win the core markets in the world, and the core markets in the world are primarily US and China.
And what do you think that sovereign wealth funds or entities within governments can do to help, spur the ecosystem or, jumpstart the ecosystem? What catalysts do they need to help make their ecosystems better?
I think the biggest thing that you need to do is build bridges to focus on the knowledge gap or the go-to-market gap between these places. Like there is no reason why again, look at Saudi. Like they have a world-class research university, which is KAUST. It like hires from the same schools at like a Stanford and MIT or Harvard. Like that's where their postdocs are from. So they have a world-class research university. So they are capable of producing IP and publishing at the same level as the world. The question is, if someone there wanted to set up a company and they're starting in Saudi, they don't have the ecosystem of Silicon Valley. They don't have the links into the go-to-market knowledge about how to scale in the Bay Area and how to scale and win over the American enterprise, the American consumer. So you need to build more bridges between these two places. You can run a global playbook out of one of these places. Europe has exactly the same criticism. Like we have plenty of IP that we create in all of these places, the UK, France, Germany, et cetera. The question is, how do you commercialize them to the next level? And you need to build more bridges versus less bridges. But instead, what they're doing is closing off the borders and putting the money locally and then building a whole like network of locally oriented funds to focus on winning in the country, which doesn't like that feels like you're missing a trick. Like if you have the power to build bridges, bridges generate more trade. Focusing on like looking insular, I think only weakens you as an economy versus makes you stronger.
So when you hear stories like or news of like say Qatar Investment Authority or PIF, launching these dedicated venture capital funds, do you think that's like a good thing, or do you think there needs to be more collaboration cross border?
It's a part of the problem, like it's a part of the solution, but it's not the solution. Like, so France itself does the same thing. So France really wanted a French tech economy. And so Macron like worked to get as much French money back into the French ecosystem to create an influx of startups. And that's what's happened in France. There's a lot more startup activity today than there was like 5 years ago, definitely 10 years ago. There's like a real community there. But so much of it stays in France. And so you end up with these like absurd French companies that are focused on the French market, and then eventually they get acquired by the French telecom provider. Like, it's like they lose out on all the potential and the upside other than a handful. And the few places where they have done this really well is like, the Meta AI engineering team is run by a guy named Jan LeCun, and Jan insisted on living in Paris, and all of a sudden that Meta AI team is very plugged into the rest of the world in the AI community, and it's a world center in Paris, and so now you have bridges across, and like the Mistrals of the world are global, and like giving like Anthropic and like an Inflection and some of the other like well-funded like large language models in the US kind of a run for their money. I think you want more bridges than just local money plowing and locally focused on the local insular market.
Do you also think that part of the problem here, or part of the challenge here, is that the education system in a lot of OIC countries is not up to scratch compared to, say, like France or the US?
I mean, that's true on the whole, but again, the barriers for entry in the tech industry are not as high as they used to be. Like there was a time where you couldn't really set up a company if you weren't a PhD because you needed to be on that kind of frontier. You have kids dropping out of like sophomore year at Stanford, it's like second year of university, building companies that become worth a ton of money. Like the bar is much lower than it used to be because the platforms are much more democratic, the tools are much easier. There's enough talent like in all of these places. But like I remember I was talking to someone political at Azerbaijan, and they were like, which like small country. And then my advice was like you should go figure out how to use like the Iranian market because most people can't sell into the Iranian market, but you're like their next door neighbor and they have like 80 million people. You guys have 4 million people. You should be building products and using your capital base to sell to the 80 versus like sell to the 4. And they also so they refused to do that. So I thought that was kind of absurd. And then the second thing they said, we want people to build these kinds of next generation tools, product services, but we don't want them to get too free. Like so like we want them to build like a social network, but we want it to be controlled by us. Like, okay, fine. Like, like I don't think the US can control TikTok. Like, how are you going to build a proper functioning app that has government controls over it? Like, we want people to be free, but not free enough. So like these kinds of things are real challenges, I think, much more so than the talent problem. There are plenty of gifted developers in all of these places. They could be high school kids for like tinkering on their own, but they know how to build these things. And then the question is like, how do you give them enough capital to be the starter fluid? And then how do you get them to think much more global versus much more local?
And why do you think a lot of big American or big international venture capitalists, they only go into like the really big markets? They're not looking, or they go into the more established ecosystems in the OIC. Why do you think they don't go into like the more frontier ones?
It's like they don't care. Like the beauty about the Bay Area is it generates a ridiculous amount of wealth. And like maybe we had COVID and it scattered a little bit more and we went all virtual. But like again, there's like a knowledge economy now in the Bay Area around AI. Like you don't need to leave the Bay Area. Like I went with the Minister of Trade here a long time ago, like 2011 or something, and we made a trip to the US with this guy, Stephen Green, he was the chairman of HSBC, like a very senior guy. And he basically wanted to meet with a bunch of VCs and say, why don't you come and invest in my country? Like we produce really good IP in the UK. And there were like 25 people in the room that were like shockingly blunt to him. They said, when you go back to your country, when you figure out how to produce some value, when you figure out how to produce some companies, our capital will come. But like your problem isn't us coming and stimulating your economy. Your problem is you don't create anything that's actually useful. And so go figure that out. Like, and then, he came back and he took that advice to heed. And then he ended up producing the CDIS investment program, which, encouraged angels to be the starter capital because he knew the Bay Area capital wasn't going to come. And if you look today in 2024, Axel is here, Sequoia is here, Andreessen is here, Lightspeed is here, General Catalyst is here, Bessemer is here. There's a ton of Sutter Hill is here. There's like a ton of venture funds that have done exactly what they said they would do. Is like when you start producing like real valuable companies in the economy, their capital will set up an office here and start investing in those companies. So that the starter ingredient is how do you get the first few like success stories to kind of blossom. And the worry is if you make them too insular and too small, and they only work, say, for the Saudi market or for the Azerbaijani market, they never get that big or interesting, and the capital never comes, and you're stuck in this kind of vicious cycle for a long time. This isn't hard. This is like 99% common sense. I don't understand why like the Public Investment Fund or the QIA, et cetera, don't run this kind of playbook. They have more than enough capital. It doesn't take very much to kind of jumpstart these economies, but they're so national focused. Like I remember in Qatar, the QIA set up a local program in Qatar, but the local program had to go to Qataris. It couldn't go to immigrants. Like 50% of the value in the American tech market is generated by people who are immigrants. Like, and that's in the US. You think like someone who's got a super cushy job in the government who doesn't have to worry about money because Qatar distributed a bunch of land to people, so they generated wealth for the local, has the same like drive as someone who's like a Pakistani immigrant to Qatar. Like, why would you lock the Pakistani out of capital because you want to be nationalistic? Like, it just feels like it's a really good way to shoot yourself in the toe and prevent growth in the economy.
Yeah, there's definitely some, the business environment in some of these places doesn't cater to
You can't
venture.
become a resident in these countries. Like, why would you ever want to go to one of these countries? Like, other than like you're forced into it because you have no other place in the world to live.
Yeah, no, I hear what you're saying. I think it's a work in progress and it goes case by case. And like you said, right, you know,
I
it doesn't.
think that the ambition is there and the stuff, like, I don't, they must be hiring like McKinsey or BCG. Like, that's probably the wrong thing to do. They just need to sit back and think about first principles and think about common sense as to how to jumpstart an economy versus hiring a bunch of consultants to like tell them don't invest in the Pakistanis in the country.
Yeah. As we bring the podcast to a close shortly, Hussein, I got two questions for you. What's your view on the outlook for VC in 2024? Just global VC. Are you optimistic this year compared to last year?
So I think there's a difference between what's my outlook for like tech and like venture type investing, what's the outlook for like the venture industry. Because the venture industry is in a bit of an overhang where we spent a lot of capital really fast and we have bad returns, or we have returns that are on paper and they're not going to turn into real. And there's like it's going to take some time to clear all this stuff out. And at the same time, we're on a massive transformational engine, which is AI, which is going to change the way people work, change the way jobs are done, change the way like businesses are run. And this is probably not like a 1 year or 2 year change. This is probably like a decade's worth of like value that's going to get created and unlocked. If these two things happening at the same time, I'm very bullish on like the tech markets and the ability for people to capture this stuff. But not all of us, like we're fortunately like pretty insulated from this stuff, but a whole bunch of our peers have legacy problems that they have to deal with while continuing to focus on the future. So the future is really good, but all the dumb stuff that you did, the quick commerce deals, the scooter companies, like you've got haircuts to take. And so you're in a bit of like usually when you have to go fix stuff, like stuff isn't working the right way, it doesn't empower you to think about the future as much because you're very stuck and hampered by the past. And so this is the conundrum that we have in the venture industry. And I don't think it's going to resolve itself in like 1 year or 2 years. It's going to take a few years for this to get out of the system. But the future is like super bright in terms of where these companies can actually go, especially the ones that are building on top of these new kinds of models that can allow.
And which countries and sectors do you think provide the most exciting opportunities for this year, do you think?
It's hard to know. I mean, I think a lot of our investing over the last 6 months has been more enterprise focused and consumer focused, and then also deep tech focused. Like, I feel like where you can apply these AI things are either in business settings, you can do some processes a lot better than you otherwise can do, or you do them in deep tech. You're solving hard scientific problems and able to kind of solve them and kind of get to scale. That's where I think a lot of the dollars are going to go. I don't think it will go into consumer, and I think the consumer space is largely, sadly, a bit of a monopoly at this point, like with Google, Meta, et cetera. So like those guys will incorporate the latest and greatest stuff. Apple as well. Like, and I don't think there's going to be an easy playing field on that side.
And finally, Hussein, what are your projects or what upcoming things are you working on with Hoxton, or are you doing anything else on the side?
And our biggest thing is like growing these companies out. I have a generation of companies that are very new, which are in my third fund, and a generation of companies in my second fund, which are like maturing and like growing and scaling. And my job is, we have a 6 year gap between our first fund and our second fund. So like, if you think about your children, you have a 6 year gap between the children. My first generation of children have done really well, which is to deliver structures, et cetera. And my job is to make my second generation of children and my third generation of children to be the same size type companies or even bigger. So that's where most of my energy goes.
Great. And Hussein, people can get hold of you or contact you on Twitter or elsewhere. How can people get hold of you?
Twitter is really easy. It's hkanji, HKANJI. And then my email is just HK, like first initial, last name, at hoxton.vc or hoxtonventures.com if you want to type out the entire thing.
Great. Great. Hussein Kanji, it's been a pleasure. Thanks for coming on the podcast.
Thank you for having me.
Thanks a lot.